Okay, welcome everybody to today's Q1 Market Update webinar. Today we're going to cover an economic update, a 4PL and procurement trends, and I'm excited to introduce you to today's speakers. Okay, today we've got, make sure everyone's on. There we go. Today we've got Mazen Danif, our Senior Applied Scientist, Russell Zupo, our VP of Consulting Services, and Nathan Adams, our VP of Procurement, in that speaking order. So at this time, I'm going to go ahead and turn it over to Mazen, who will cover our economic update.
Thank you, Rebecca, and good morning, everyone, or good afternoon. So as usual, I'll start with an economic update covering the goods economy or the total US economy, focusing on the goods sectors. And then what does it mean for freight and specifically trucking in the US? So I'll start with our supply and demand indices. These are indices that I put together based on to measure how much freight supply is there or how much truckload supply specifically is there and truckload demand. So the demand index is a weighted combination of what you're seeing in the manufacturing sector, consumer spending, wholesales, imports, and exports. And the supply index basically is a combination of how many drivers are there and how many trucks are there in the market to serve this demand. So the story here is that you've seen a gradual increase in demand over the last few months. It's not a sharp decrease, but it is an increase nonetheless. Demand has rose about 0.3% in Q4, and this has been mostly driven by consumer spending on goods. On a year-over-year basis, demand was about 0.4% lower year-over-year. Even though it's still in negative territory, this is the best observation we've seen since a very long time, maybe since September of 2022. On the other side, supply remains stagnant. So the market has stopped adding capacity in terms of trucks and drivers. It has been mostly flat over the last few months. It remains 0.8% higher year over year, but that is also the lowest we've seen since going back to March of 2021. So the gap between supply and demand remains high, which means that the market remains loose or remains soft. But this gap has been gradually closing because the rising demand over the last few months has closed about 30% of this gap. So what is driving this demand increase? So in the next slide, we see consumer spending on goods. This is data from the US government, from the Bureau of Economic Analysis, and it shows that after 2 years of stagnation, or after 2 years of flat spending adjusted for inflation, we've seen that consumer spending on goods has been on the rise again, especially in Q4. So we've seen it return almost to a long-term growth trend of about 3% or 3 to 4% year over year. This has been mostly driven by the non-durable goods sectors or the big ticket items that we buy once in a while, like motor vehicles and furniture and appliances, but mostly motor vehicles. If you're in a non-durable goods industry, you might not be seeing the same increase in spending. So growth in non-durable goods has been positive, but it has been limited to about 2% as compared to about 6% in the durable goods sectors. There are various reasons driving this increase. I'll mention a few. The first one is an increase in real disposable income. So even after adjusting for inflation, we see that incomes have increased about 4% over the last year. Also, despite the narrative that there's a shift in spending from goods to services, the data is showing the opposite. It's showing that spending on goods has been outpacing spending on services in the last 12 months. And finally, we're seeing that consumers continue to save less and spend more on goods. So spending on goods is still very robust. I'll move to the wholesale sector now. This chart shows wholesalers' sales and wholesalers' inventories. So sales are shown in blue and inventories are shown in black. I'm excluding some bulk sectors to focus on the truckload, what drives truckload freight. So excluding sectors like petroleum and farm products, coal, etc. But the story here is that sales have hit the bottom around early last year or early 2023, and they have made a slight recovery after that, or like a slow recovery. On the other hand, inventories continue to decrease. They peaked around towards the end of 2022, and then since then, wholesalers have been cutting their inventories. Some sectors are still adding inventories, like motor vehicles and machinery, but these move on specialized trailers, so they do not contribute specifically to truckload demand. If we exclude these sectors, we find that wholesalers' inventories have dropped sharply over the last year by about 7%. At the same time, sales increased by about 2%. So also the gap is closing here. The third sector I'm going to talk about is the manufacturing sector. This chart shows the manufacturing PMI, or the Purchasing Managers Index. It's a measure of the overall health of the manufacturing economy. And any value above 50 here implies expansion, and values below 50 imply contraction in the corresponding sectors. So what we're seeing here is that the manufacturing sector has seen contraction for about 15 straight months now. All the values have been below 50. The latest value, however, was 49.1. It's very close to 50, and it's the highest value we've seen in about 15 months. This means that the manufacturing sector is near the bottom, or it's bouncing near the bottom. It's likely to start increasing or recovering soon based on what we're seeing in the new orders index. This is an early indicator of how much freight demand is in the pipeline. This has increased above 50 for the first time in 17 months. We've seen new orders growing month over month, and this is a positive sign for freight demand as well. Next slide, please. So now we're putting all of these together. We see that these are indices that I develop as well, and I translate all of the above data in terms of dollar spending to what it means in terms of freight tonnage. So what we see here is that real spending on goods has been increasing, as I said before. It has made a full recovery compared to where it was in the height of the pandemic. So it's almost back to its all-time highs. Wholesaler sales has also been increasing, but it's a bumpy road. It made a partial recovery, but not back to its all-time highs. And the manufacturing output, as I said before, it's still bouncing near the bottom. What it means for total truckload demand is that truckload demand is almost flat year over year. It's negative 0.4% year over year. But it is still significantly lower than the cycle high, or where it used to be in early 2022. It's about 5% lower. So now I'm moving to the supply side. This chart shows truckload employment. Truckload employment is shown in black, and the subset of that I like to focus on is called long distance truckload employment, shown here in blue. So this is a better predictor of spot rates if you're in the truckload sector, or specifically like truckload supply and demand. This is the best predictor of, this is the best index for supply that I like to focus on. What we see here, especially if we look at the blue line, is that we're still bouncing near the top. We haven't seen any major correction yet, but we've seen a gradual reduction of capacity, especially in the last two months. Capacity has decreased by about 4.1 thousand in the long distance truckload sector. We don't see the same trend in the total trucking employment. We see it still increasing, but that is driven by very specific sectors. To mention a few, there's the LTL sector, where carriers have been hiring some of Yellow's former employees as they absorb the Yellow's volumes. There's also a significant increase in employment in local freight, which is tightly related to consumer spending on goods. So we expect this employment to continue to decrease, especially in the long distance truckload sector, because as carriers' revenues fall, or as contract rates fall, carriers react to that by reducing their headcount. This relationship is obvious from this chart here, which shows the year-over-year change in contract rates and the year-over-year change in truckload employment. There's a very tight relationship, except that there's a 10-month lag. So employment lags contract rates by about 10 months, but reacts to that. And we expect this correlation to continue to hold. Based on what we've seen here, we've seen contract rates fall by about 15 to 20% year over year. And based on that, we should expect capacity to decrease by about 3 to 5% year over year in terms of driver employment. This might be one of the factors that put pressure on spot rates. So why does this happen? Simply because carriers' margins are deteriorating. So the next slide shows carriers' operating costs, shown in the red line here. They remain significantly above spot rates, which means that the spot market is unprofitable for carriers. Operating costs per revenue mile are even approaching contract rates, which means that even on contracted freight, these carriers might not be making positive margins as they did before. So this means that the current rate environment is not sustainable. This is consistent with what we saw with a lot of carrier earnings, where we saw that the operating ratios are very high, about like more than 95%, indicating like low single-digit profit margins. This is much worse for smaller carriers because they drive much more empty miles and their operating costs are much higher. So this brings us to the discussion of rates. This chart shows spot and contract rates for the three trucking modes: van, reefer, and flatbed. We have seen an increase in January and in December. This was driven by various factors: seasonality, weather, etc. So December's increase was expected. We expect to see a sharp increase in spot rates around that time of the year, but January's increase was counter-seasonal. We expect rates to decrease in January, but this year we saw an increase. This was partly due to weather conditions, but even after the weather conditions have mitigated, we still see some lagging tightness in the market. This might be a sign that rates have hit the bottom. And where do we go from here? Usually Q1 is a soft quarter. We see softness. We see rates going down. We've been seeing some of that in the last few days after the weather conditions have ended, and we expect to see that continue. But then starting Q2, end of Q2, especially when produce season kicks in, that's when we expect to see an increase in rates, and especially spot rates, and contract rates will follow as well. So with that, I'll turn it to Russell to go over some of the trends we're seeing on the TM side.
Thank you, Mazen. So I'm going to go ahead and cover some trends in the 4PL transportation data and a little bit about what we're seeing in consulting services. So next slide, please. So first off, we like to look at tender acceptance and really how often carriers are taking the freight that we're offering the carrier. So this data comes from our managed transportation service that covers billions of dollars of freight under management across multiple industries. So it's really kind of an aggregation number. And what we can see here is, the first tender accept is literally as it sounds. It's the first tender that goes out to a carrier on a route guide. Are they taking that first tender? And you can see we're coming in January around 92.6%, and slight trending down, but really we're kind of holding steady at very high levels. Steady state markets from maybe 8 years ago were typically more like 80, 85% acceptance. And so when we look at route guide compliance, the difference there now is maybe if the first carrier did reject it, does it stay on the route guide with other primaries or backup carriers before going to spot? And you can see that's coming in at 95.5%. So both of these metrics that allow us to track carrier compliance across multiple different shippers are trending down ever so slightly. You can see kind of in the second half of 23, they're both trending down, but they continue to be high, and that downtrend just supports that slight tightening in the market that Mazen was talking about. The result of carrier compliance is what kind of inflation are we paying over our primary contracted rate. And so, as carriers reject more, the amount you pay for spot tends to be higher. But right now, we're really in a de-risked market, so that 6 or 8% that carriers are rejecting isn't resulting in a lot of inflation. So on average, it's a 2.1% right now. And I think that little uptick in January is a little bit more weather related than anything else. Next slide, please. From a service perspective, I think I'm showing 2 ahead. But from a service perspective, what we like to track is lead time. So we look at lead time and what kind of lead times that the shippers give the managed transportation service. And that tells us when an order is ready till when the first pickup date is on that order. And so from a lead time perspective, I think we're averaging about 9.5 days now. We've been trending upwards for the past 4 years. And that lead time is really an indication that shippers are doing a better job of planning and kind of making sure that their orders aren't delayed in the process. On the flip side of that, what we try to look at is service. So we look at service a little bit through an index lens, because if we start to just measure pure carrier on-time service, it becomes really challenging between different shippers and different metrics they like to use for service. So what we've done is we come up with an index that really evaluates from when that shipment order is received, when are there any changes along the way that would delay it from the original must arrive by date? So those sometimes are shipper related, sometimes facility related, whatever it may be. But we're trending at a pretty high level there as well. And 71% is pretty steady. So I think the real story here is it's more of the same, very slight market tightening that we're seeing in the 4PL data to support everything we're seeing on the macro side. So next slide to look at kind of what we're seeing on trending. This is really kind of our ear to the street, right? So what are we hearing from the customers? What kind of projects are we helping in our supply chain consultancy? And so the first in transportation, Nathan will talk a little more about this, but we're really seeing a lot of bid activity, just a tremendous amount of bid activity right now as shippers want to get ahead of any market shift to come later this year. A lot of anticipation on that. And just in pockets, we're starting to see some carriers not take all the freight they're awarded or not go in to take surge freight, really just in pockets and early signs of tightening. And then lastly, on transportation, sustainability is still a big topic for a lot of shippers. And what we're seeing in a general sense is in the US, we're not seeing a lot of shippers that are willing to invest in sustainability and emissions reduction heavily, and at least in the logistics side of the house. But we see more of that in Europe. What in the US we're seeing more than anything is trying to find win-win scenarios with intermodal where you can still reduce some cost or maybe take a cost neutral shift so that you can save on emissions. And a little bit occasionally a shipper is willing to actually pay more for intermodal to save on emissions. We are seeing more shippers interested in alternative fuel. So we're doing a lot more evaluation on using biodiesel or gas, either independently or as part of a bid event. And so, I think there's going to be a continued push down that path as well. From a warehousing and distribution standpoint, an interesting thing's happening in that space now where we're seeing new warehouse construction completions are continuing to climb and at a really high level, kind of, sort of in a lag to the need that popped up through the COVID with. But new construction starts are continuing and going to continue to even slow more. So the interesting thing there is it might present some good opportunities for shippers that are looking to grow or need to change space. This might be a good time to capitalize it. Warehousing rates remain the same right now. They're still fairly high, but we expect those to ease over this coming year. So if you're looking to grow, you're looking to turn over a 3PL or contract or whatever, this is also a really good time to look at optimizing the network. So we're seeing a lot more interest on our consulting service side for that because it seems to be a glut of contracts coming to an end in 24 and 25. On an inventory management side of things, while inventory is sort of depressed, and we hear in the news and we hear these anecdotes of inventories are going to increase, we're really not seeing that with the shippers we deal with. We're seeing shippers keep inventories lower than pre-pandemic levels. Really, from an uncertainty standpoint, they don't want to invest in inventory just yet. And that's also supported by import, right? So imports are growing, but they're not at levels that would be proportional to pre-pandemic at this point. And so on that same note, similar to what we're seeing with warehousing and distribution, we're seeing a lot more interest in inventory optimization right now. We're seeing a lot more interest in manufacturing companies that want to reduce inventory and have a smoother manufacturing flow, look at plan for every part and kind of plan their transportation and inbound flow to a just-in-time schedule. And so there's a lot of activity around what can we do to keep inventories low and still be able to deliver service to our customers. So that's what I've got from a consulting services and a 4PL trending. Nathan Adams is going to talk a little bit more about our procurement.
Yeah, thanks, Russell. If you want to go to the next slide, please. So I think Russell hit a couple of these high points, right? So again, like record bid activity, there's a lot of bids out on the street right now. We have not seen our customer base, at least for the bids that we control and perform. It hasn't slowed down at all. It's actually a pretty heavy Q1 amount of bids out there right now. I think that's for a couple of reasons, right? So, shippers are starting to try to really insulate themselves from potentially what's coming down the pipe. I think Russell mentioned, he's hearing on the consulting side. Folks are really trying to say, hey, if I haven't bid this out in a while, or maybe I carved out segments of my network to work with certain carriers on, and as we all know, these networks will age and get a little stale as business changes. And so if you don't bid your lanes out over time, you'll start to degrade either the volumes or the service or whatever it may be. So I feel like a lot of folks are trying to reset their network now ahead of a potential increase in price. So we're also seeing, again, the shippers are taking their entire network out to bid in a lot of cases, versus in the past we may have carved it up a little bit and done multiple bid cycles potentially, or only poor performing lanes, or only cost lanes where they're out of process on the cost. But now we're seeing that where the shippers are really trying to get out there and get a whole network reset. We're also seeing a lot around just the quality of the data and the modeling and the lane hierarchies, and how do they bid, right? Instead of point to point lane, maybe they're trying to get a little consolidation of volume, trying to get some better pricing, some more density on lanes, looking at forecasting, and really trying to get an accurate network out there. We all know the challenges on that space, but we are starting to see a lot more effort on the front end around the data standpoint, on the bid setup and the accuracy of it. From a carrier standpoint, we're continuing to see carriers cast a wide net in bids, not as wide as it was probably about 6 to 9 months ago, which I'll show you some data on the next chart. But they're casting a wide net, but then they're also not casting it on every lane. We would typically see last year about this time in a much more down market, it was carriers were almost bidding on every lane, and brokers are bidding on every single lane, just trying to see what sticks. Again, they're casting a pretty wide net the way they bid, but they're not bidding on everything, right? So they're starting to narrow down that focus a little bit to really what's critical to their business. A lot of the carrier latest earning reports are coming out, and there's been some struggles on the truckload side around their operating ratios and pressure on price, right? So I expect them to really try to make a lot of that back up as much as they can this year, as we go through the year and go through the bid cycles. And again, with that on the carrier side, brokers are continuing to be really aggressive, and they're still casting the very wide net across all lanes, trying to see what they can get. We know there's been a lot of entries into that market in the past, and so folks who may be newer to it and just trying to keep that brokerage business up are really trying to get whatever volume they can, and they're casting a large net in these bids. Pricing, from a pricing and a saving standpoint, everybody's baseline is a little bit different, but we're still seeing some good savings coming out of these bids. We're comping against some already pretty good savings from last year, but we're still seeing some savings, just not as obviously high as it was last year. But we're starting to see stuff creep down into that single digit savings, higher single digit savings than we have in the past, where you were in the double digits, depending on when they bid their network. So view the next slide, please. So this is just a graphical representation of what we see in bids. So if you see the black line, that's like our entry point. Those who are familiar with the RFP world, you run your base scenarios and kind of just give me a cost and capacity and what's the, I guess, minimum viable product from a solution standpoint. And that's that top line. So we all know the base scenario is not what gets implemented and is not the, obviously the business scenario we want to go with. So after running all your scenarios, you land on kind of the blue line, right? So you can have your initial go-in price, and you land on what my final scenario is on a blue line from a savings perspective. And so you can see that was really widening that gap, back in 2002 and in the beginning of 3 and some different things, right? So that the gap is widened, which, from our standpoint, that means the carriers are really casting a broad net. There's more differentiation on the rate, right? You have a wider spread of rates per lane. So you just have a larger focus of people underbidding the market, trying to get business, trying to see what sticks, could be paper rates, right? And some other things. So, excuse me, you can see that starting to kind of come back together now, right? So folks are getting a little more rational about what they're bidding on versus just kind of throwing every rate at the wall. And we're seeing less of a wide dispersion of rates per lane, if that's making sense. So next slide, please. And just looking forward to this year and best practices, right? So we all feel the market will shift, or at least we're projecting the market's going to shift probably through the at the end of the year. So there's stuff now that shippers can do to get prepared for this, right? And it all goes back to what's your best practices and how good is your relationship with carriers. How are you creating long-term partnerships and working on the right things just outside of being a transactional rate play, right? So how are we working with the carriers on tech? How are we partnering with them around what they're doing with their technology? How are we getting information from them? Can we do that more efficiently and work on some of these larger scale programs with the carrier base to get more involved with their company versus just being very transactional, right? Obviously, you can't do that with every carrier, but your strategic carriers should be aiming to have those longer term plans and outlooks and strategic discussions top to tops versus just the transactional side of it. Again, understand your carrier's technology, understand their pricing, what they're doing, their cost pressures in their environment. They're going to want to have those conversations, and you'll want to understand kind of where they're playing, what they're looking at, where they're understanding their 2024 is going to go. Meet them where they are in their tech journey. There's a lot of API talk out there. Some carriers are very ready and can go put APIs in place very quickly. Some are still developing those. And so work with them on it, help them along. If you have certain requirements, like partner with them, help them understand one, the impact it has on the business, why it's important, and how to kind of get them to that end goal. Also from a volatility standpoint, like understand where your rates are, like benchmark, understand what to expect, monitor throughout the year, understand as things go out of process. There could be pockets as the year moves along that tighten and weaken, and just make sure you have a good pulse on your network as well. And again, I kind of reiterate this: just work with your carriers, understand their cost pressures, understand pain points in their business where you can be good partners, and also vice versa, share pain points in your business where you need the carrier's help and where they can be good partners, aggressive in certain areas, and really help the business move forward. And then just work again with the carriers on the strategic cost and the transparency around it. I know we all bid in a vacuum, but sometimes it's good to just have those open and honest conversations on why rates are the way they are. So interesting year again. There's a lot of activity in the shop. To sum it up, carriers are starting to see a little bit of a light at the end of the tunnel from their standpoint, trying to get their business back in order from a rate standpoint and a cost pressure standpoint, to take advantage of the market on the back half. So that is what I have from my standpoint. And so now I will pass it back over to Rebecca. I think we'll get into a little bit of Q&A. You can unmute, Rebecca.
Got a first timer over here. Sorry, you guys. Yeah. Welcome back, everyone. Please drop any questions into the Q&A box that you may have. And thank you all for the great update. This is for you. We do this for you so that you all can take some of those best practices back to your company and those data points and market headlines. We will be sharing a copy of this deck with you post webinar, so heads up for that. We will also be sharing with you our full market outlook report, which goes more in depth on modes and different pieces there. So again, feel free to drop any questions that you may have into the Q&A. I haven't seen any come through yet. Give it just a few more minutes. While we're waiting for any additional Q&A, guys, any closing remarks, any final thoughts that maybe you didn't get to state during your presentations?
Yeah, maybe I can talk a little bit about what we're seeing in terms of the forecasts for next year. So we develop our own forecasts and we track a bunch of external forecasts. And most of these external forecasts are predicting a positive increase in spot rates over this year, over 2024 compared to 2023. So they expect that on average rates on 2024 over the whole year will be higher than the rates we saw in 2023. That's specifically for spot rates. Contract rates usually lag spot rates, so we might see them lagging by a bit. But in general, most of them are positive. There's a wide range, ranging, I think, from 2% year over year to about 25% year over year. So we're we're still not over the volatility. Otherwise, these forecasts are expected to converge more. But in general, like most of these are positive. We expect spot rates to increase, especially in the second half of the year, in Q3 and Q4. That's when seasonality kicks in with the summer produce. Contracted rates usually lag by about like 6 months, so they might be negative year over year in the first half of the year, but might turn positive after that. So these are all uncertain forecasts. All models are wrong, as they say, but this is what the market is expecting, or what industry experts are expecting.
Great, thank you for that. And that actually is a nice segue into some of our questions that we've got in the bank right now. So Mazen, I think this is for you. So in relation to, in relation to long distance trucking reduction in employment, is that due to drivers leaving or moving toward shorter hauls?
So that's mostly, we're seeing a trend in, previously we've seen a lot of drivers come into the market, enter the market, especially when rates were higher. And as their margins got thinner, we saw a lot of drivers starting to exit the market, either because they had their authorities revoked or because carriers eliminated some jobs. So of course, like not all of these drivers are exiting the industry. Some of them are getting hired back into the LTL sector, where there's like more demand now after Yellow's bankruptcy, or in other local trucking sectors. But I would say it's a mix. Like some will completely leave the industry, some will get hired back.
Okay, thank you for that. Nathan, what lanes do you see are currently surging in volume? This might be Russell too.
Yeah, honestly, from a surge perspective, I wouldn't say we're seeing anything that is not being handled from a capacity standpoint, right? There's obviously some increases depending on folks' business. The good thing is we have visibility and customers kind of across all industries, so we get to see the surging industries as well as not. So it really depends on the seasonality, but I don't have a very specific market or region that is tighter than one another. Obviously, we mentioned some weather on there, so anything weather related in the Northeast or out West is obviously going to have impacts. That's going to back up shipping and then cause those surge bubbles at a later time. But I don't have a specific pressure point right now in the U.S. from a capacity standpoint that we've been struggling covering in our network. So Russell, I don't know if you've seen anything on the consulting end. Russell, you're on mute. I think Russell froze up, but him and I talk often, and that's some of the stuff we speak about. And we haven't seen any pressure on that side of the house either.
Oh, we lost Russell. Okay, well, Nathan, I've got another one for you. Do you see more shippers bidding quarterly versus annually? And when carriers are bidding quarterly, are they getting savings each quarter?
Yeah, so that's a good question, right? We saw a lot of that probably a year, 18 months ago, when it was one of those options of like, how do I break up my network? How do I have less exposure out there? Especially when the market was tight, 2+ years ago. Folks are really trying to get creative around how they do it. There was some experimenting on bidding per quarter. When you're bidding the repetitive lanes quarter over quarter, it honestly doesn't move the needle that much that we saw. There's obviously some pockets in the seasonal world that if you're going to surge 50% during fall peak season and carve that off, you kind of do get a little bit of benefit from bidding that. We've seen most people come back and consolidate their volume to an annual type award again, and so that's what we're seeing a lot of this year. Haven't seen a lot of conversation around the bidding quarterly or bidding monthly. Now, from a network standpoint, we recommend that you do your annual bid, but that if you have to do maintenance bids throughout the year, throughout the quarter, throughout the month, that's where we really encourage you to take advantage of those quarterly bid processes, and I think you get a little more bang for the time. Just because once you have that good baseline set, you can measure against it and then understand what's out of process, and then go to triage that stuff throughout the year. So that's typically what we recommend. A lot of folks are having success for it, but we aren't seeing as much of just a clean, I'm going to bid out half my network this quarter and half the next, and that type of format.
Good. Okay. Mazen, you may be able to answer this one. What is your assessment of the recent earnings releases for publicly traded carriers?
Yes, I think it's all expected. What you saw in these reports, margins getting thinner and thinner because a lot of contracts were repriced, so the operating ratios got worse, the margins get worse. The other thing that we expected to see as well as, and we saw, is some capacity reduction. So we've seen a lot of these carriers reducing the number of employees and the number of trucks they reported in their earnings. So this is all expected. This is about like as bad as it gets for a lot of these asset carriers, probably near the cycle bottom. But yeah, it's expectedly bad.
Agreed. And then I guess to that note, Nathan, who do you think has taken the majority of YRC's volume? You may not be able to answer that.
Yeah, it really got absorbed a little bit across the board from some of the larger carriers. Obviously, it was an easier shift to move a national amount, national amount of freight that was with Yellow to another national carrier. But we did move it into pockets, right? So just from our network, and we do a couple billion in LTL, so we have a lot of good insights to it. With that YRC shifting, we really did go back into our network and see where we had competitive rates and pricing and what gaps we had, right? And so a lot of that business did fall back to some of the other national public held carriers, but we did also try to leverage some of the niche players in our network as well. So I'd say it wasn't just like one big shift over, to a competitor of YRC's, but it was more of a, people went out, analyzed their rates, saw where it made sense, and let's shift volume to, LTL carrier A, and this goes to B, and this goes to C. Now it wasn't always that clean, as some of the carriers may not have had capacity at those networks. So it's a little bit of rework, and then maybe you go to a niche player. But I'd say it's hard to quantify just all the YRC volume went to this group of carriers. What we did see is before it happened, we felt we were running at about 90% of capacity in the U.S. for LTL. YRC was about 10%. And so obviously there was some room there when they went out that all got dispersed. It was hectic for a little bit. It stabilized. But now, a lot of the domestic US capacity is full on the LTL side or getting close to full. So that's why we haven't seen such a decrease in price in those networks as much. We're actually still seeing some increases in pockets. And we continue to see there be pressure in that capacity if we start to turn the corner on the marketing, right? And more freight gets added into that world. It may be drive price up or be a little tougher to find a home than it has in the past couple of years.
Okay. Mazen, do you think more drivers will enter the job market looking for local and LTL work?
So when you look at the trends of how many drivers are entering the market, it has been decreasing over time. So I wouldn't say specifically because these two sectors are seeing increased employment that we'll see more drivers entering the market. It's likely to be that more drivers will be hired into these sectors, but the overall trucking employment, we expect it to stay flat. When we look at FMCSA's authorities, the surge in new entrants into the market has decreased significantly. So it's almost back to where it was pre-COVID, while authority revocations remain high. So to answer that question, no, not at scale.
Okay, thank you for that. Nathan, I've got a question for you. Do you send out carrier awards on an annual basis, and any specific benefit you see, and do you do it for all modes?
I'm assuming that's carrier of the year. It's kind of what we call it on our standpoint, and yes, we do them annually. We don't do them quarterly at this point, but we do publish a annual carrier of the year across multiple modes. Obviously, us being a very, very large shipper from a revenue standpoint, we kind of have all modes from LTL, truckload, intermodal, refrigerated, even into tanker and bulk and international. So we do give out awards annually for all those modes, and it's kind of based on a lot of the metrics and key KPIs that we track internally, and then also feedback from our operations team, right?
Yeah, and I can piggyback a little bit on that as Nathan and I work closely on this event for our Carrier of the Year awards. So we send out a full package. We want you to share it on social with your networks. We have a physical award that goes with it. It is a big important program to us that we get excited to share out at our Carrier Summit every year. So for those of you that are invited to that, more information to come, and best of luck to you. We have a couple of additional questions that are for Russell, and I will ping those to Russell. If you have any more, please drop those into the chat, and we can certainly follow up with you post-webinar. Again, as a reminder, a copy of this recording, a copy of today's presentation, along with our full-blown Q1 market outlook and report will be shared with you via email once this webinar is over today or tomorrow. And thank you all for joining us. We're so grateful. And thank you to our speakers for participating.
Thank you.
Take care.
Thanks, everybody.